Welcome back. And here we are talking contracts in the office.
Really interesting.
In a studio in an office.
On a sunny day.
On a sunny day.
Get me out of here.
It's a good thing we got an incredible view up here.
Nice.
Yeah, and you can see a lot of property out there. And one thing that's really interesting for people, I think, is property valuation. And first of all, welcome back to Glen Thiessen with Transition Planning, Inc., who helps families plan ahead for the major transitions in life and also offers investment advice and securities through KMS Financial Services, Inc. Welcome back, Glenn. How are you?
Thank you very much, Ben. It is great to be here as always.
And well, it's good to see you. And we saw you at our 1-year anniversary bash last week.
That was so fun. You have such a good crowd of people.
Well, thank you.
They love you.
Thank you again. So let's get into a little bit on this financial planning aspect and evaluating property, because it's a big thing that people don't always think about, but it's important.
Right. Actually, what I'd like to do is focus on the leverage as a concept. Leverage can work for you or it can work against you. So let me give you an example how leverage can work. Let's say that you have a piece of property at $100,000 value, and you're going to pay for that property. Let's say you give them $100,000 and then it goes up by 30%. The new value is $130,000. So you've now gained $30,000 with an input of $100,000, right? So that's fine. That's good. You've probably seen property go up 30%, right, over time?
We've seen it go down 30% over time.
I'm coming to that. Let's say, though, that you only put $50,000 down to buy the property and the bank owns the other $50,000, right? And it goes up 30%. Now your property is worth $130,000 still, because you go from $100,000 to $130,000, so it's up 30%, but you only put in $50,000. So if you were to sell the property at that point, you sell the property at $130,000, take away the $50,000 that you put in, you have $80,000 in your pocket.
So what we're really talking about here is the power of leverage.
Exactly.
And the ability to put less money into an investment than the full value.
Right.
But have the full value increase.
That's right. But you always have to be mindful of how much the bank owns versus how much you own, because that will really make a difference in terms of how leverage works for you or against you. Right? Remember last time I was talking, I said there's good debt and bad debt. This is an example of good debt, where you are leveraging your money to invest it, and actually the investment works well. So let's say that you now have a 60% increase. You went from $50,000 to $80,000 in your pocket. That's a 60% increase. The property only went up 30%, but you gained 60% on your money. That's a pretty good gain. So let's say that you were doing this with a whole bunch of people and you had shares in this property representing $10 value. Your share just went up $6 to $16. That's a pretty good increase, right? But let's say what happens, and we've seen, like you said, the property value can go down by 30%. Let's say you start out with that same $100,000 property, you put in $50,000, but now it's worth $70,000.
Uh-oh.
So how much does the bank own of that property still?
Well, they would still own $50,000.
Exactly. So it's your share that actually took the hit. So if you were to sell the property, now you've put in $50,000. You get $70,000. You only had a $20,000, $20,000 gain.
Right. So, I mean, I think what's important to really realize here is when you start getting into the numbers,
right.
And if we speak in more general terms, is that the money that you invest, although when you leverage and the property goes up, you do get a much higher return on your equity.
That's right.
But when the property goes down, the bank doesn't take a hit because you still owe that money.
That's right.
So it doesn't come down or go up in really, I suppose, an equal way.
Right. Of course. Because, it's so much better to have a 60% increase than a 60% decrease. But let's say that
no matter what, really. Let's be honest.
Yeah.
A 60% increase over any decrease.
The thing is if you didn't leverage, you'd have only had a 30% decrease instead of 60%. It's the leverage that made the difference, because the bank still owns their part. It's your share in the equity value that really changes and either helps or hurts you. But let's just say that you hung in there and the property now went from $70,000, increased 30% again, to now $91,000. Again, you've only put $50,000 in, so you have a $50,000 debt, all right? And so basically you've got a $70,000 value minus the debt, which the bank owns, you have $20,000 equity. The property goes from $70,000 up 30% to $91,000. You still, if you were to sell it then, have to pay the bank their $50,000. Yeah. But now you have $41,000 equity, right? So what happens is you went from $20,000 equity or ownership in the property to $41,000. That is a 105% increase. Okay, so but
that's after you already lost a bunch of money,
right?
Yeah, that's what I'm wondering.
Yeah. But so it depends again on investments. It depends on when you got in, and did you get in just before the fall, or did you get in just after the fall, right? So it really does make a difference here.
How much, when you work with people on their investments, and you work with, you look at property and you're looking at stocks and bonds, how much property, whether it's in real estate on their own, whether it is like, say, a REIT, or maybe it's a construction company or development company, how much real estate across the board do you think is a good idea in a portfolio?
Well, it historically has been a very stable type of investment, and if you use it for like income and appreciation, it's been great to have probably up to 10% in a portfolio in real estate. And a lot of people mistake the fact that they think that their house, where they live, their residence, is a real estate part of their portfolio, and that's really not. It's a personal use asset. Now, speaking of debt, let me just mention there also, for people who are over age 62 and maybe tight on their retirement budget, and perhaps it's helpful for some people, not everybody, to do a reverse mortgage. Okay, so that is a concept that's a good type of debt because it helps them. It might eliminate a mortgage that they otherwise would have had that they couldn't afford anymore because they're now retired on a fixed income and inflation has driven up their expenses. And so, they've got to make some adjustments. Well, you got all this equity in their house. Some people still do. We've seen a lot of the equity evaporate. But the idea is if you still have...
It's coming back, though, Glenn. It's coming back.
Slow but sure. I'm hoping that it continues. The idea is turn that equity into an income or at least eliminate the mortgage payment so that you can afford perhaps the long-term care expenses that you're having and so forth.
But, and that's the hard part with people with the properties, right? Mm-hmm. Is you end up, let's say it's even $1 million house and you own it free and clear.
Right.
At the end of the day, you're just living in it and that $1 million isn't doing anything for you. It's not helping you pay the bills. It's not helping you. You just live essentially rent-free.
Right. Right. And then, like when next year the estate tax, deduction drops back down to $1 million and you've got your $1 million house, boy, you're really quickly at that limit. And that doesn't include your 401k and your other assets and so forth. So again, what do you do with that property? Consider highly appreciated assets and what to do to get those either out of your estate or reduce the value. There are many different strategies that can be used. But again, we started out today talking about debt and leverage. It can work for you, it can work against you. I normally try to help people be debt free. So like on personal debt, don't have a car loan, don't use credit cards, pay them off if you do, and eventually I'm an advocate of having your house paid off.
We're here with Glen Thiessen, Wealth Advisor with Transition Planning, Inc. And, so getting rid of that debt, it's really about freeing up cash flow, isn't it?
It's becoming financially independent. See, what that means is that you have control over your income. And if you eliminate the control that other people have over your income because it's spent before you even get it, then you have the freedom to either store that differently, to invest it, to give it away to charity, organizations that are important to you, help the kids out. There's so many things that you can do if you have more control over your income and give other people less control. So again, debt also can hurt you because you pay more for an asset than you otherwise would have. For example, last time I mentioned, you buy something on sale, 30% off, and you put that on the credit card and you take 10 years to pay that off, you have, eliminated the deal.
Right? The other big one, I think, is when people go buy cars.
Yeah.
And they think, well, I can either get 0% financing or $6,000 cash back. What people don't realize is you've already financed that number in. That's why they offered you $6,000 cash back to buy it with cash. And, a lot of times when people will come to us with mortgages and debt consolidation, like, well, I have a 0% loan on this car. And we say it's because you already paid the interest.
Yes.
You need cash flow right now. So,
exactly.
When you buy those cars, it's really important to understand a lot of times how much more you can pay for it or how much less you could get it for.
Right. There are too many people drowning in debt. And it happens layer by layer by layer. It takes a while sometimes. Some people go into debt really quick, but other people, it takes a while to get into it. So it's going to take a while to get out. But strategies that you can work out to accelerate that process is well worth it because it feels so good to be debt-free.
Well, and debt can also be, it goes up exponentially. You would owe more money, just as investing in, say, a 401k or IRAs or whatnot also can go up exponentially.
That's right.
So you got to figure out which side of that not a bell curve, what are those called? The ones that go up or down?
That is bell curve. Well, it's called hockey stick thing,
The hockey stick curve. There we go. I think that's the technical name for it, too.
Yeah. So I just wanted to mention also, thinking of compounding, I did mention, like last time we were talking about the feasibility of Social Security, is it like really viable? So the unfunded liability portion, $118 trillion, is growing at $10 million a minute. Okay, just think about that. $10 million a minute. And your share and my share, every taxpayer's share of that debt, the unfunded liability right now is over $1 million. You are over $1 million in debt.
Well, I do have a nice house, and I did buy it at a bad time, but knowing that I have to pay that to cover, the old folks' Social Security, man, I don't know about that.
Yeah, it's kind of scary.
Do you think that is a scary concept, isn't it? What could happen in the next 10 years, 15 years?
I don't know how our kids and grandchildren are going to actually pay for it. So it's difficult.
We'll be printing money, handing it out, because that's new.
Well, yeah. But every time you print the money, it becomes less valuable, right? So it takes more of your dollars to go ahead and buy the things you do now. So
not a good solution.
It's really tough. There are very difficult decisions. But if we start, cutting back on the spending, both personally, corporately, government spending and so forth, we can get a handle on the budget and therefore start paying down the debt. And then we're all going to be a lot more free.
Well, and at some point in time, they're going to have to extend the age at which people collect Social Security.
Yeah, that would help.
But it will never happen because we're always in some sort of election year.
Right.
Every 2 years. So nobody can make the hard decisions. That's a whole another topic, isn't it, Glenn?
Yes, it is.
Glenn, good to see you, buddy. And stick around. We'll chat a little bit more at the end of the show. Again, Glen Thiessen with Transition Planning, Inc. When we come back, real estate is a topic on our show pretty consistently. And some people might want to know the finances of renting or leasing their own place for their own new business or selecting the site or even building out new construction. Matthew Royal is going to join us when we come back. You're listening to Brashenomics.